So recently, I've been getting loads of comments and emails and messages about how you can't time the market and how time in the market is better than trying to time the market. Now, on the whole, for most investors, this is probably true, but I'm certain that everyone watching this video right now is also timing the market, and I'll explain why. Now, if you're watching this video, I also don't think you should be of this mindset, and as part of this video, we're going to talk about how you can become better at timing the market. It's also important to say here that timing the market isn't a bad thing either, not at all. Every hedge fund manager, every asset manager, every sector-focused fund, any true professional investors all time the market, and doing so generates them market-beating returns. The main reason we have this belief that timing the market is bad is because most people who invest in the stock market do not really take an active role in understanding the main drivers of the market and the developments. They're invest and forget style investors, and this is the majority of the retail investor community. By being somebody watching this video, you do not fall into that category, and you are definitely at the upper end of the spectrum in terms of taking an interest in developments in the market, and probably somebody has a good sense for sentiment across various sectors and why things are happening in the market. Now, this goes against what so many people on YouTube say too, but as ironic as this sounds coming from somebody talking about this in a YouTube video, don't listen to anyone on this platform. As we've seen exemplified perfectly over the last few months, many content creators who do this and rely on the income from it are dictated by the algorithm and produce content based on what the algorithm will push the most and what will pay the best. This is flawed, and so you really need to act with serious caution when watching videos on YouTube. Now, for the avoidance of doubt and for full disclosure, my full-time job is in something called private equity. The money made from this channel is negligible, and on a per-hour basis, it's a fraction of minimal wage. I do it out of pure enjoyment and interest, not for financial gain. Anyway, let's go back to the main point here, that everyone is conditioned to assume that timing the market is bad and impossible. Yes, it's clearly hard, and you'll never get it spot on time and time again, but at the same time, it's something which the best fund managers do, and retail investors who closely follow the market do too. It isn't rocket science, and by doing this, you too will generate superior returns over time. The only scenario where time in the market is better than time in the market is if you invest entirely in index tracker funds or whole market ETFs and invest a consistent amount of money each month, and this only holds true over the very long term. If you are investing in any specific stocks, any derivatives, investing in any specific sector-focused funds, then in a way, you too are also timing the market. Now, stick with me for a moment here. Everything about markets are cyclical, and all of this fundamentally comes down to broader business cycles and the impact this has on the allocation of capital across various asset classes. Within these broader market cycles, be it a bullish or bearish cycle for equity markets or stock markets, you also have sub-cycles, certain sectors, certain categories of stocks performing better than others. When you take a position in a specific stock, you're inherently timing the market in that you sense and believe that category of stock, say a FANG, a growth stock, a consumer staple, whatever it may be, will outperform the market, and this is a form of timing the market. If you're read up and informed around the market, understand the dynamics at play, and have identified dynamics which will drive the growth of certain specific stocks more than others, for whatever reason that may be, then this can be a positive decision to time the market. Now again, you will not always get this timing right, or spot on, and sometimes it can go against you, of course, but this is where the importance of effective portfolio management comes in. Always make sure you have enough capital to increase exposure to a position, provided it's still a good one, and that you didn't make a mistake in your original judgment. The concept of dollar cost averaging is definitely a valid one in these dynamics. Build your position over time and don't commit all of that capital on day one. This is what professional investors do, and that's a really important lesson to learn. So, why do so many people encourage time in the market and not timing the market? Well, as I've mentioned before, the majority of investors are very passive in their coverage of the news, and for them, the best strategy is just to continually invest in the stock market in full index trackers or ETFs and just invest consistently on a monthly basis. If you are an investor who does make specific calls on certain stocks and you hold individual company stocks, then you can try and dress this up however you want, but you are trying to time the market in some regard. Assuming it will outperform the other stocks, that the sector, the fundamentals, the growth, whatever it is that attracted you to invest in that company originally, will drive that company to outperform. So with that said, what we all want to know is how to get better at timing the market. Now the painful fact here is that you will never get it right 100% of the time, but even that is better than just following the market or kidding yourself that you're not timing the market at all. The next important disclaimer here is that this is not some get-rich-quick scheme. As I always say in relation to things touted as those, or shortcuts to achieving wealth, they don't exist. Stop trying to find these and chase these things, and just fundamentally learn how to become a better investor. Invest more money into the stock market and you will get there eventually. It's a marathon, not a sprint. Now, with that out of the way, the best way, and this is not just coming from me, this is what the best performing fund managers over the last 50 years in the stock market have done, is by identifying long-term structural growth patterns and dynamics and investing into those. Said differently, identifying areas where growth of a specific sector or market, for whatever reason, will outweigh that across the rest of the market, and over time, capital will flow into these areas and stock valuations will appreciate. There are loads of examples of these. They can be focused on specific sectors, regions, types of market, whatever, but the important thing is that these are long-term structural changes that underpin the dynamics rather than a short-term trend. Now, let me give you an example by contrasting two potential situations. One may be the electrification of transport, while another may be Bitcoin mining stocks. Controversial, I know, but stick with me. The electrification of transport trend is clearly going one way. There's enormous global political pressure and incentivization to make this happen at an increasingly quick rate. And on top of this, there are social, environmental and economic interests which are also driving this dynamic going forward. We know how much growth the market has to deliver in order to achieve these targets set out, and we know that the investment, the government subsidies and incentives, and the market is only going one way in terms of growth. Clearly, diving a layer deeper, you have a bunch of different markets within this trend, whether you want to invest in specific EV manufacturers, which personally I think are a little overheated right now, and also I do struggle a little with the high capital expenditure requirements and the high level of execution risk among many of the pure play EV manufacturers. Instead, I'm looking here more at services into this, whether it's lithium producers themselves, other battery metal producers, charging infrastructure, battery recycling. All of these areas of the market are interesting and present significant opportunity over the coming decade. Now, I've been an investor in crypto for ages now, since 2013 or so, and I've always said that ignoring Bitcoin and some of the other main cryptos from a balanced portfolio is irresponsible. But that also means that this is weighted appropriately, and for me it's single-digit percentage allocation to crypto, maybe very low double-digit at the absolute maximum. Anything more than that is irresponsible, and again, probably verging on the domain of gambling. The crypto market is really volatile, and while the adoption of it is increasing among both retail and institutional investors, it doesn't have the same geopolitical support or commitment from governments and network effects yet to outpace the electrification trend. The growth in popularity during the most recent bull run in crypto has resulted in a load of investment from the main mining players in buying new rigs. Shortages occurred and increased the prices for these rigs even further, and ultimately paying more at the start, i.e. a greater capital outlay, results in a lower ROI. And when you factor in a waning crypto market currently, the ROI decreases further. Now, I appreciate this is a stratospheric level overview of the comparison, but this is a starting point, and there are a bunch of other examples. To list a few of these, you have the legalization across the various states in the US of online gambling, both casino and sports. Now, this is a mature market in Europe, and the taxation potential is being recognised by many states currently, and that is supporting the continued derogation of this market. Now, it won't happen over months. Instead, it occurs over years and years. However, there is a clear economic rationale for federal and state governments to push this forward. Now, the legalisation of cannabis is another market which is clearly underpinned by long-term growth dynamics. While legal in some states for medical and recreational, there's a clear agenda for moving this towards federal legalisation. As a candidate for president, Biden supported the legalisation of the market, but as a president, we're yet to see any action from him in this regard. As his support is potentially waning, is this something we will see accelerated and pushed up the agenda ahead of the midterms? We are already potentially seeing a bit of this with the renewed talk around the Safe Banking Act, basically allowing regulated banking businesses to invest, finance and even provide simple banking services for companies operating in the cannabis sector. Now, there are a bunch more of these markets and opportunities to time the market, too many to list, but this is key to finding sectors within the market which will outperform the broader market. By doing this, you're timing the market. You believe these parts of the market will outperform, and that is timing the market whether you like it or not. The sooner we're honest and open about this, the better. It's not bad, it's not impossible, and it's a strategy anyone can harness to make superior returns. Anyway, that's it for today's video. Thanks a lot for watching. I hope you enjoyed it. If you did, please smash the like button, subscribe if you aren't already, and check out the Patreon for the private Discord. As always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear all the different opinions and perspectives, so please get involved. Thanks again for watching, and I'll see you in another video.